I like talking about markets. As you can see right here, we've done extremely well over the last few weeks, maybe 50, 60, 70,000 in the last few weeks. Make sure to like this video and subscribe if you want to see more videos on how to achieve that. But what I'm going to talk about is actually a different kind of market. Not all these stocks and all these things. I'm going to talk about what to do with cash in terms of the housing market. So you can see I do have some cash in here. I'm actually going to be deploying all of this cash into the stock market. That's just my stock market cash, and I'm going to be sharing in future videos. If you're subscribed, you'll see what I'm doing, what I'm buying, when I'm buying it, and being super transparent. And I'm only being super transparent because I'm not actually showing my face, so I'm okay with showing you what's going on in my account. But I actually have some cash laid on the side. I have it put inside high yield savings accounts. So HSBC Direct is one of the banks, which gives me 1.6% on my money. Another one is American Express's personal banking. I have money in there, and that way it's FDIC insured because it's over 250K. And so I want to use that money to buy a home and also to buy properties for income. And I'm going to be sharing how I'm doing that, when I'm doing that, and make sure to subscribe and like this video if you want to see those videos in the future. What I'm going to talk about in this video is actually the housing market, and I'm going to look at big data. So there's companies like Realtor.com, there's companies like Zillow.com, there's companies like Redfin that basically have a ton of data. They own the data in terms of seeing, how many home sales are there, how many buyers are there, how many sellers are there, how long does stuff stay on the market. That allows them to see trends before it's visible to everyone else. So I'm really looking at big data, big numbers. And these numbers might be a little surprising. Like, for example, right in front of you here, it's the median home price is expected to go up by 1.1%. So this is the median home price. It's different than the mean home price, which is also used when people talk about averages, but this is the median home price. So what that means is there's a million homes and they're all organized by price. The 500,000th most expensive home, that's the median home price, okay? It's the price of that home, the one that's actually in the middle. It's not the actual average at the top and the bottom, and you combine them and divide by the amount. So they think that median home price is going to go up. And they see a lot of data, as I said, and I'm way more interested in the data that these companies have than, say, a talking person on CNBC, right? Because they have the actual numbers. And what's driving this and what's going to determine if the housing market goes up and down and if you guys can buy a house, if you're age 25 to 34 and you're a guy, there's chances are you're maybe looking at buying a house. I'm just saying that demographic data because that is probably who you are, right? Like this video, if that's you. Mortgage rates affect that a lot because this is the amount of interest you're essentially going to spend on your mortgage. So this adds up a lot. You can type in mortgage calculator on Google and you can basically get a calculator here. And the mortgage amount, say you're doing $100,000 is your mortgage for a house. Or if you live in a city, let's maybe make it $1 million for a house. Why not? Cool mill. So $1 million for a house and you are mortgaging it. That means you're taking out a loan for $1 million and this is your interest rate. While this might seem low, 3.9%, over 30 years, this will be a lot. $702,133 of interest you paid. So even though you took out a loan for $1 million, you're gonna have to pay back $1.7 million. Okay, and you pay that in monthly payments. So you might not realize how expensive it actually gets. And this is a really low interest rate. Say it was back in the day and it was 10% rate, or guess what, 20% rates for some homes. Okay, we're talking about decades ago. And so when they were, even though they seemed like really cheap homes, if you calculate the actual interest rate and how much that affects the price, look at $6 million for $1 million mortgage, you're like, wow, that's crazy. But that actually used to be the prices of interest rates. Check out the 80s and you can see because the federal funds rate was so high, interest rates were high as well. Talk about the interest rate in terms of the federal funds rate in my last video, so you can go ahead and check that out if you want to learn more about that. But this is the actual rate that you're paying. So it makes a big difference if it's 4% or 3%, right? So 4% to say 3%, we're going from 1.7 mil to 1.5 mil. So we're saving 200K. That is why it really affects the demand, because if your interest rate is lower, your monthly payments are lower and you're able to afford more of a house. So as these rates go lower, which they will most likely trend lower, it's already at all-time lows in history, but as it trends even lower, demand is going to be stronger because of that. Now, let's talk about supply, because there's two things, right? There's demand and supply supply has to do with how many listings are on the market, how many houses are on the market, and something strange is happening, right? So we're seeing less low supply. And it's not that strange when you think about it, because who the heck wants to sell their house right now? Who the heck wants to go look at finding a new place to live, moving, and all this stuff during a pandemic? No one wants to do that. So the market listings are really low. They're starting to be listed more and more. So we can see from a couple weeks ago, compared to last week, it's changed, but it's still really low compared to last year. So this is 29% down compared to a year ago. And if there's not a lot of supply on the market, well, that moves up the home prices, right? And Realtor actually thinks the home price will increase 1.1%, right? The median home price. And that's a factor of supply and demand. Let's talk about supply and demand real quick, just as a little economics lesson. I learned about this, had to do ton of these in college before I dropped out and started a business. But let's talk about what I learned while I was there, shall we? So this is the supply and the demand curve. So supply slopes up, demand slopes down. That's that D right there, sloping down. And price is on the y-axis and quantity is on the x-axis, or the horizontal right here. So where these two meet is pretty much how a product or service or whatever should be priced in the market. This is based on stuff that's not real, in terms of like consumers knew all the competitors, they knew the other prices, and they knew everything, and everything was just as convenient to buy, then this would be the price. But consumers don't know that, but they do their best, and the prices end up going to, let's say, an average. And this is where the average hits, where the demand and the supply hit. Let's call that the average. Now, this is a little confusing when you think of, hey, there's different kinds of homes, right? There's $1 million home on the coast, and there's a $50,000 or $100,000 home in the middle of the US, right? So it's very different. Everything is regional with real estate, so it depends where people are, what the markets are. Little markets can do very different than other markets. But overall, supply and demand controls the price. That's what I wanted to talk about. So right now, supply is actually shifting to the left currently, okay? So what that means is supply is lower. So it's going that way where that arrow is going. And when supply goes lower and it moves towards the left, then where it hits the demand curve, you can see right here, is at a different point. And see how it goes from 110 to 190 in this example? Well, that is the change in price, right? Because if supply goes down, the actual price will go up. Now, how much this price will go up will actually depend on the demand curve. It depends on what's called the elasticity of demand, how sharp this demand curve is. Now, if demand falls, also the price is going to fall. You see the new P2 is lower than P1. Unemployment is absolutely crazy. So unemployment is decreasing in terms of the trend, but it's still adding. So what that means is we still added 3 million new claims of unemployment. So even though it looks like it's going down, that's just the trend. But the amount of people is still 36 million. So that it's the whole amount under this. So what is this going to do? People are out of jobs, and also small business owners are probably going to be out of business as well. So I'm going to look at these two different categories, the small business owner and the employee, and talk about how that changes the prices. So the main thing is that people are not going to be able to afford houses. The people that are maybe just at the brink of about to give up their house and they're barely making those payments, maybe like for the last several months, guess what's going to happen? It's going to tip them over the edge, and maybe something happened at their work, maybe they got laid off. That's going to trigger a lot of issues, right? That's going to trigger a sell-off. So in my opinion, what's going to happen to supply and demand is that supply is going to start increasing, okay? Right now it's low because no one wants to move during this pandemic, but when people will have to move, that means people will have to move and they'll have to list their houses. Now, an important thing about understanding the housing market is that people still need to live somewhere. Okay, so if people are moving, where are they moving to? They don't just disappear. Some people maybe will move back in with their parents, let's say, hopefully that's not you, but people are usually moving from one place to another. So in this instance, maybe from a house to a cheaper house, or from a house to an apartment. And what that's going to do is that the cheaper houses or the apartments, well, maybe they're going to have a little bit more demand, right? Maybe there's going to be less supply of them available because people are moving into those. Whereas the more expensive things, let's say $500K to $2 million range of people that maybe were middle America. Of course, middle America could be a $100,000 house, depends where you live in the city or whatever, and up to maybe small businesses that own $2 million houses, let's say, as an example. Those people are going to start moving and downtrending. So the supply of those houses is going to go up, whereas maybe the supply of lower income places or apartment buildings might go down, and because there's a bigger demand as well. And on the flip side of that, if people want to move into a house, where do they move in from? So maybe millennials, or people in college, or people that are at home at their parents, or live in apartments. Are they going to move into houses? Are they going to take over that supply of houses? Probably not so much right now, right? With this pandemic, with probably a really, really tough job market, and with all of the bankruptcies that are going to keep on coming to employers that are not looking to expand and get more employees. So I don't see that big shift, which was planned, right? The millennials moving into houses. I don't see that huge shift, but hopefully millennials like you guys, if you're watching, can take advantage of the lower prices, which I think are guaranteed to come. So that's always important when you're looking at data like this. So median home prices can go up, but that could mean that certain prices of homes go down by a lot in certain price ranges or in certain locations. So when are we going to see that happen? When are we going to see the big moves? I think a lot of this has to do with the mortgage relief options that the government's coming out with. So the government has a lot of stuff that they're trying to do to not cause a housing crash, not cause an absolute depression in the markets. And one of those are mortgage relief options, ways you can relieve your mortgage. So if you have a home, this is probably important for you. And if you don't have a home and you're trying to look into when is the best time to buy or buy in a dip, when can you expect that? It's important to see this as well. So the first thing is, if you can't pay your mortgage, then contact your mortgage loan servicer, okay? So contact them. All right, but here's basically what happens. Okay, so there's a CARES Act relief option for all federally backed mortgages, which is most of them. So the first thing is that a lender, like who gives you the loan, can't foreclose on you for 60 days after March 18th. Now, this second one is probably more important. So second, if you experience financial hardship during the coronavirus pandemic, which is essentially every single person that is looking at this above, you have a right to request a forbearance for up to 180 days. You have the right to request an extension for another 180 days. How many days does that make? Well, it makes 360 days. It makes a year. You might contact your loan servicer to request this forbearance. So what forbearance is essentially puts a pause on your mortgage without additional fees, penalties, and interest. And basically, it allows you to suspend your payments or reduce your monthly mortgage payments for a limited period of time while you regain your financial footing. Forbearance does not mean your payments are forgiven or erased and you're still required to repay any missed payments in the future. If you have a Fannie Mae, Freddie Mac, okay, these are the huge loans, you don't have to pay back that suspended amount all at once. So what that means is, let's say you put it on pause for 4 months, you don't owe 4 months of payments all at once at the end, okay? So you can actually pay it off at one time if you want, spread it over months, or maybe add it as an additional payment at the end of your mortgage, which is probably what most people are going to try to do. So what I'm trying to say here is for the next 6 months, okay, we're not going to see the full effect of this because there's a forbearance for 180 days or 6 months, and then maybe they'll even extend it, but I think a huge amount of issues are going to happen in exactly 6 months from now. So let's actually talk about the future. Here's a very important aspect of future housing prices. It's the housing start. So this means how many houses are being built, how many houses are being started. So that affects supply dramatically, right? And housing starts fell 30% from March and 29% from a year ago. So this is a huge, huge downturn, down 20% in April and March, in terms of the permits. Home completions fell 8% from March, so that means that like people are even slowing down completing homes. I'm seeing more homes on the market that aren't even completed. Monumental decline in home construction activity. That means that there are so many less homes being built. So in 6 months or so, when these things would be done, pretty much at the same time that those forbearances are, people need to start paying, guess what's going to happen? There's going to be less supply, but there is also going to be people trying to move out of their houses. So this is going to help prop up the price, the fact that there's less supply on the market. So what do I think is going to happen to the market? Well, first off, I think supply is going to increase dramatically over the next few months in terms of houses. People are going to try to get out of houses, and there is going to be a sell-off as small business owners can't afford their mortgages and employees have been laid off. That's the supply curve going to the right. What does this do? It lowers the price. I think of demand going to the left and lowering price further. However, I don't see demand as being a hugely impacted thing. I think mortgage rates will still be low and are trending even lower, so people will try to be buying, always trying to take advantage of opportunity. As this pandemic starts wearing off, I think more supply is going to land on the market because people are now okay with showing their house, with maybe moving, and with dealing with the health impacts of it. So I think that this housing market is going to transition from its weird state that it's in now, which is more health-based, where people don't want to sell because they don't even want to go outside. It's going to transition into an economic downturn where people actually can't afford their mortgages in the maybe 4 to 8 month range. I think we're going to start seeing potential lows, and that people need to sell their houses and move. So is there going to be an absolute crash? I don't know, because there are things that are propping it up. For example, housing starts are not happening. For example, your interest rates are at all-time lows. The stock market doesn't add to any more panic because it seems like things are maybe somehow okay. So if I had to say, is it a good time to buy? Is it a good time to sell? I don't know. However, I am opportunistic that prices will be going down in the future, and looking at data from Zillow or from Realtor, we can see that maybe it's going to go down towards third quarter, maybe around October, I think is what Zillow says it thinks it's predicting it's low. Not sure about that. I think that a lot of the economic data is not factored in properly. I think we're going to see a domino effect of bankruptcies affecting other supply chains and other businesses. That's why I do think it's good to keep some cash on the side, not dependent on the stock market, so you can use it for rainy day stuff or property investments. So that's what I'm doing. I want to keep cash on the side in certain accounts so that they're not in the market. So if the market takes a huge dip at the same time that housing starts freaking out and people are selling massively and driving the price down, I don't want to have to sell my stocks to float those property investments. So I'm keeping cash in those high yield savings accounts like American Express's personal savings, which I have a high yield savings account with them. Also have more money in HSBC, where we have a high yield savings account with them. And I'm going to use this cash when I can to buy a home for myself, which is more of a luxury than an investment, and then actually use it to buy properties, maybe quadplexes or multifamily homes. Something also that I kind of wanted to dig into maybe in another video, because I feel like I'm making too much content in each video here, is this trend, and that working from home opportunities technically make suburbs more desirable, right? Like, who needs to live in the city if your business that hires you is letting you work from home and you can buy a nicer home in the suburb instead of a junky studio apartment in the city? So this might create a cultural change. So what I'm talking about is cities may overall go down in demand because businesses realize they can save a lot of money by not having people come into the office, right? You don't need to buy as big of an office in the city. So it's going to save businesses a lot of money to realize they can do Zoom meetings instead of in actual meetings. And suburb prices might go up and city prices might tumble down. The hottest markets, according to Realtor, in terms of people searching for stuff, is Colorado Springs, Fort Wayne, Topeka, Pueblo, Columbus, Ohio. So we're not looking at New York City, Los Angeles, San Francisco, Miami, right? We're looking at smaller places. And while I wait for this guy to tell me that trading is not good, let's click skip. If you guys have seen this guy in all the ads, he must be crushing it. Is the CEO of Redfin talking about how he thinks there's an exodus from expensive large cities. So essentially, people are going to move from large cities and they're going to move to smaller suburb type towns and less expensive places. It is super important to realize that real estate is completely based on the area. It's completely based on the price point, the type of real estate. Commercial is different than residential. So everything is going to be different. Real estate is very much a local market. But overall, those are some of the big supply demand factors that I see in place. Hopefully this was a valuable video. I'm excited to be able to take advantage of this opportunity. If you guys are young like me, then I think this could be a great time. So keep your eyes peeled, look at data, subscribe if you want more videos. I would love to grow our subscribers. I'm going to be doing something special for the first 1,000 subscribers that I get. I'm not sure exactly what I'm going to do, but if you're one of the first 1,000, then you're going to be eligible for it. And I'll talk to you guys very soon. See you later.